We've just heard from the banking sector, good set of results from Stanbic, but let's move now to the construction sector of the JSE Securities Exchange, namely Group 5, whose year-end numbers were released earlier today. And in the Joburg studio is Mike Upton, the CEO of Group 5. Mike, you did flag us that these numbers wouldn't be exactly the most glamorous ever, but when you see them again, as I always say, when you see them in black and white, not particularly good. You've got an operating profit decreasing by 45.3% from 605.6 million to 331.4 million. Headline earnings per share decreased by 64.4%. So a tough time, but are you sensing there's some consolidation and maybe some hope for the future?
Yes, Lindsay, thank you very much for having me. It's been a year which has been quite robust for us. We've been able to sort of crystallize quite a few issues that were building up over a year or two, and it all happened really in June, so we weren't able to really guide the market much more than we did in our trading update. But we have dealt with the Middle East, which has been quite a long-running issue. We've dealt with our construction materials. There's an issue in India which has had a long tail to it and really seemingly without end, which we've closed out. And we've done quite a lot of restructuring in the organisation, refocused the business. So it is sort of resetting the base is how I would describe it.
Yeah, the Middle East is an interesting one, isn't it? Because everyone thinks of the Middle East and looks at the oil price and looks at the expansion and looks at the way the airlines are doing and how these extraordinary construction sites and thinks, well, it must be a gold mine, but clearly not for you.
It's a very difficult market, you know, sort of culturally and commercially, and also the legal frameworks there, you know, really only get sort of tested when you need them, and you know, that's found to be wanting to an extent. But we've had a good run in the Middle East. We've made money there, but you know, when the tide went out in sort of 2008, we were left with quite a large number of contracts that were still running and which we closed out, and two which were cancelled. But it's the commercial closure of those. You know, when your client has really got no money, and you know, they have the ability to obfuscate, if you like, the closure process, it becomes very difficult. So it's been expensive for us, but we have got to a place now in a global settlement with a large client or two that has cost us money. But I think, you know, rather that than we continue the pain. So we've actually sort of taken that on board, we've dealt with it, and hopefully that sets the base now.
Yeah, the press release that I got from your kind people this morning says the following. The first thing that it says, it doesn't talk about operating profit down or revenue or whatever. It comes straight to the point. It says market conditions remained very weak, and it goes on to say SA market conditions remained weak, although medium-term prospects have improved. And what I said to an earlier commentator was quite interesting. It says the order book exposure to the SA public sector down to 31% of construction order book, construction being 81% of your business, of course, according to these latest numbers. Are you happy that it's down to 31%? In other words, less reliance on the public sector?
I think we are. You know, we did do a lot of the work around the infrastructure theme up to the World Cup and beyond that. We have got very good relationships with government and with the state-owned enterprises, but we do sense that it was possibly weighted a bit too heavily in favour of South African public sector when there's quite a lot of uncertainty in terms of the timing of the infrastructure theme, you know, or the one that's ahead of us anyway. So we think sort of 30% is the right number. It's going to change, it's going to move over time, but I think more in line with you know, where our focus is. It's to certainly be a partner to government and infrastructure, but equally to make our growth out of the African theme, which is, you know, really what we see is our route forward going into 2013 and 14.
So you're pinning your hopes on Africa, and you're probably pinning your hopes on two specific sectors of African development as well, economic development that is, and that is resources and infrastructure. Are you making good roads into the African continent?
We believe we are. You know, we're working there now. All of Group 5's businesses now have work in Africa, which is a new milestone for us. Equally, of course, you know, our order book is 38% now outside of the country, and most of that is in Africa. And we have got a very good track record in execution, particularly in the mining and resources environment, and expanding that in sort of partnering the retailers who are moving into Africa as well. So we see Africa is the big theme. We have a very good experience base there, and we should use that.
Yeah, I mean, it's been so obvious to many people and many companies for quite a while that we've got this the rich resources on our doorstep, just north of our borders here. What about the margins, though? How are the margins? Because everybody seems to be moving into Africa, and that's a very, very good thing because it's necessary. But are the margins quite skinny?
The margins are better in Africa, particularly in the sectors which we work in, but equally the risk profile is higher. So I think it's risk and reward. We've managed to have a very good run in execution in Africa. And so, we've been able to meet or maintain or improve the margins won at the bid stage. And that's encouraging because logistics and things are very unpredictable in Africa. But we have got a good base. We've been working there for 15 years. We're expanding our country sort of portfolio, 1 or 2 countries a year. And we think it's a good part of our strategy to be much more focused on Africa than we have been in the past, possibly.
One of the things I always do when I get a press release or look at some results, Mike, is have a look at the first thing I look at is not the earnings or what's happened over the last 6 months or a year, and I look at the prospect statement. You say the following: against the actions taken, we expect margins and earnings to improve in the coming year. Our construction order book has improved and the client and sector mix is more balanced. Tell us about that order book. Does it give you encouragement?
The order book it has actually been somewhat constrained, I think, by our plan over the last year and a half to actually make sure that we try to maintain the quality of the order book. That means good cash flows when we tender, good margins when we tender. Obviously, it doesn't all happen like that, but at least we've been able to maintain that, which shows in our cash line. We've got a very good cash for the year. And also in the underlying inherent margin across the group, if you remove the construction materials and the Middle East issues out of there. So I think we haven't done a bad job. And then to be able to show that you've got a 28% increase in the base order book in construction, I think hasn't been a job badly done. We would obviously hope for more. More importantly, I think, is the pipeline ahead. We do see some medium-term uptick in terms of workload, particularly in South Africa, but equally an expanding resources cycle in Africa, which goes beyond just minerals. It's oil and gas and other sorts of resources.